Hello friends, welcome to A to Z Learning channel. Today's video is about stock options, our favorite topic. We'll talk about put or call options. We'll deal with all the key terms that one must know while dealing with put or call options. And most importantly, we'll touch on who is this suitable for? Is it meant for individual investors, retail investor, or is it more of a tool for big investors? Or is it suitable for both? We'll talk about all that. Are there any safe ways for us to deal in these options? And at the same time, we'll touch on, are there any particular strategy one must avoid to make sure that they are not incurring heavy losses? We'll go through all of this. But most importantly, as we always say at A to Z Learning Channel, that we'll try to do this in as simple way as possible. Please do give us your comments as you go through and remain with us till end as we have a quiz section to test your understanding at some point in time in this video. So without any further delay, let's proceed with the video. So first of all, the question is, what is option? Option is nothing but a form of financial derivatives. What is financial derivatives? Bear with me. I know it may be getting confusing because I'm using these big, heavy terms, technical terms with you, but bear with me. It will all make sense in a minute. Just stay with me and it will be all clear to you. So coming back to the question, what is then financial derivatives? Financial derivatives is any security or any contract that derives its value from another asset. So it has no value on its own, but it derives its value from another asset. So that's the kind of definition of financial derivatives you must keep in mind. In fact, we are surrounded by derivatives in our day-to-day life. Share, we all kind of buy and sell on a day-to-day basis, is a great example of a highly effective financial derivative. Shares do not have any value. They are simple, a transaction, a unit, a paper if you're still buying in physical form. It derives its value. Its value is totally driven by the underlying company and the underlying company's valuation and performance. So it's a great example of financial derivative that we deal on a day-to-day basis, but we don't appreciate that as being a financial derivative. We use the term shares and are very comfortable with that. But when we say financial derivative, it sounds like a big, big term. So don't get carried away. Don't get bogged down by these big technical terms. We'll simplify for you. Let's take another example. Interest rate. We all kind of have a particular transaction from time to time to do, for example, home loan. Home loan, when you kind of subscribe for, when you take a home loan, you have the option to choose either fixed rate or a variable. Usually when you're signing up for these deals, fixed rate, fixed interest rate deal is usually expensive than the variable interest rate. But you get a big comfort, big peace of mind by going with the fixed is that for the entire loan period, you will be paying the installment based on that fixed rate only. Even if interest rates go up in the market, your liability, your installment will continue to use the fixed rate that you signed up for, that you agreed at the time of signing up that loan agreement. So that's another example where you may be paying a little bit extra upfront, but then you're buying that certainty for the entire loan period. So these are the kind of quick example that we deal on a day-to-day basis, but we don't appreciate them as financial derivatives. So going back again, that financial derivatives are basically those contracts or securities where they don't have their own value, they derive value from something else. Hope it makes sense. Please do provide us your comments. If you have any question, we'll come back to you on that. And if you like the explanation, then also give us some complimentary comments. Now, next step is basically to go a bit deeper. And when we go a bit deeper, we'll talk about stock options. So let's take an overview of stock option. Again, the first question is, what is stock option? Let's start with a definition first. A stock option is basically a right. It gives an investor the right, but not the obligation, to buy or sell a stock at an agreed price and date. There are some key terms that I've used in this definition, which I would explore a bit more with you guys. So first of all, I said a stock option gives an investor the right, but not the obligation. The advantage with the stock option is that you have the preference, you have the right to kind of execute it or not to execute it. If if at the time of execution it remains favorable for you, then you go ahead and execute it. If it goes other way around and it's not favorable for you, then don't execute it. You have the right. You don't have any compulsion. You don't have any obligation. You don't have to do it. You can walk out of it. It's like basically two parties getting together and agreeing into a contract for a future date. For example, a builder would kind of generally offer you that if you book the house by paying a modest sum upfront, you are gonna guaranteeing the price at which that flat, that house will be available to you in 5 years time or 10 years time. You are basically buying that certainty of a price, and you think that because of the surrounding areas development and with time, chances are by the time you will have that flat available for you to purchase, the market value of that flat or house will be much more than the price that you have agreed upfront. So you're basically hedging. You're taking the right to execute buying of that house for a given price by paying a small amount upfront. But at that time, 5 year later or 10 year later, when the house is ready or flat is ready, you kind of go around and look at the market. Some of the development that you were expecting in the area hasn't taken place, or other kind of unforeseen things have happened. Therefore, the market value of the flat is a lot less than what you guaranteed for by paying that little kind of booking amount that you paid upfront. Then you have the option to walk out of it. You don't have, you lose clearly that booking amount that you have paid, but you don't have to execute. So by paying that modest booking amount upfront, you have the option of executing, which means you buy that house when it's offered to you, or you opt out and say that, oh, I buy it, will buy it from a market because I'll buy it cheaper and all that. So that is the kind of key thing. A stock option gives an investor the right, but there's no obligation. Now, the second part of the definition is to buy or sell a stock at an agreed price and date. You can do the options for a buying transaction as well as selling transaction. Sometime you may be expecting that you're buying something because you're expecting the prices to go up, or you're selling something because you're expecting prices to go down. All that you kind of factor in your calculation before you come up with whatever option you want to buy. And there is a agreed price, and there is a agreed date on which that has to be executed or not to be executed if it's not favorable. Usually, now bringing in the concept of put and call into it. Put is when you as a buyer is placing a bet that stock prices are going to fall. So if you think that overall market sentiment is such that the price which is prevalent today won't be prevalent or would be lot less than that by the time that future date comes, that agreed date that you kind of buy put option for, then you buy put option when you are expecting markets to go down and prices to go down. You buy a call option when you are projecting, when you're betting that the stock prices are going to be rising because there is a positive momentum, there's a lot of good news. So this is based on the call, the judgment, the sentiment that you study. You apply all that to come up with whether you should buy a put option or a call option. But the key is that you buy put when you're expecting stock prices to fall. You buy call option when you are expecting stock prices to rise. I hope it makes sense. Let's kind of highlight the key terms. So as you can see that blue boxes have come on some of the key terms. So for example, buy. Someone who's buying put or call option is called option holder. So that's a key term for you to kind of keep in mind. Someone who's selling put or call option, they are called option writer or seller for that matter. Agreed price, that future agreed price that you're committing to buy or sell is called strike price. And then this agreed future date is called expiry date. So basically, the way to kind of understand is that two parties coming together, they're saying that I'm buying this put option for you because I'm expecting prices to go down and all that. Uh, but there is a date fix that we'll do it in December or January. Usually the stock related options, put or call, are once in a month. They are settled once in a month, which is the last Thursday of the month. So you get the put or call options for every month. So you can, at any point in time, you can buy for next 3 months. So your current month, and 2 months after the current month you can buy it for. I hope these three key terms, put option, call option, and then some of the key basic terms like option holder, who's option writer, strike price, expiry date, is all making sense to you. There's one other kind of term that we must know is the spot price. Spot price is the price of the stock on the expiry date. So clearly you agree a contractual price, but spot price is the agree a future price, which is called strike price. But the price, which is the actual price on the expiry date, is called spot price. So keep these terms in mind as we kind of go through and understand how does it work. Hopefully it is all making sense. Please do give us your comments if it making sense, or if you have any questions, shoot us comments and we'll try to kind of get back to you on those. Now let's take a break. Let's take a break and quiz. Please provide the answer of this question in the comments. The question is very simple. Please name 3 examples of financial derivatives that you use in your day-to-day life, or you have used in your day-to-day life. Please name 3 examples of financial derivatives that you have used in your daily life in the comments, and it will be really interesting to see whether you've understood the concept or not. So without taking any further time, let's proceed. Now let's understand the examples, how the put options work and how the call options work. So we'll first understand the put option code. So typical put option code is like I've listed here: Reliance DEC December 1800 P, and then there is a number 59.55. So what is all this? Let's understand. Reliance is basically the first section of the code that represents the company for which you are buying the stock option. So in this case, this is Reliance. The next thing is the DEC, December, which is the short for December. So this is a December option that you're buying for. 1800 is the strike price, is that future agreed price on which you are going to be executing your put option. So this is the strike price. Then PE is basically your put European. Put European. In India these days, you get only European put and call options. So that's the reason their code is PE, put European. There used to be a time when you had the option to buy American options as well, but these days it's only European options that we buy. So let's not confuse ourselves with the American here. PE is basically put European. And then the last is basically this number that you see, 59.55, is the premium, is the price that you pay to buy this put option. If you are a seller, this is the amount you get by selling this put option. If you are a holder, if you are a buyer, then you pay this price. If you are a writer, you receive this amount. I hope it makes sense. Let's proceed. Now let's understand this chart. In this chart, I think first of all, the y-axis is your profit or loss. Under this option, either as a buyer, you'll make profit or you'll make loss. As you can see, the loss line, this part of the chart, is flat. Means your downside as a buyer of this put option is fixed at about 60 rupees, which is this 59.55 that you've paid upfront to buy this. So that's the maximum loss as a buyer you will have. But your opportunity to make profit is basically quite huge. So let's understand that. So first of all, this little dot at 1800 you see is the 1800 strike price. So this red line is the strike price. And this green shaded area that you see here is basically the opportunity of profit that you have as a buyer. So if as a buyer you're buying put because you're expecting stock prices to fall, and if they fall, then you make money. So if 1800 strike price and the spot price becomes 1600, you can make almost 140 rupees profit on this. So that's the kind of advantage. Anything that is on the right of your strike price, so this red broken line, anything on the right means you are out of the money. As a buyer, you're not going to be making money. You will incur the loss, but your loss is fixed and fixed to the premium amount that you paid upfront, which was roughly 60 rupees in this case. Anything on the left, if the price of the security that you've chosen is less than or is on the left side of this broken red line, then you are in the money. You're making money. There is some part like this part, which is basically your still a loss zone, but your loss is less than the 60 rupees that you paid upfront. But as soon as it is higher than say 1760, then you start to make money and then there is no limit. So if price go further down, becomes 1000 rupees or 500 rupees, you make even more money in that. So that's very, very important. So as a buyer, when you buy put option, your downside, your loss is limited to the premium that you paid upfront, but your upside is unlimited. Now let's understand the call option. Coding is pretty similar to what we have seen in the put option. So first, the name of the company, the month for which you're buying, and it's always the last Thursday is the date on which this need to be settled. The expiry date is always the last Thursday of the month for which you bought. So December last Thursday, whatever that date is, that will become the expiry date. 1800 is the strike price. Now you've noticed instead of PE, it is CE now. CE is basically call European. So earlier we had PE, put European, now it's CE, call European. And again, the price is 50. For argument's sake, we've kept the kind of amount same, but there can be occasions when call has got a high premium than the put or other way around. So now let's kind of go to the chart and understand. So you can see that, so the reverse of this. Now you are expecting stock prices to go up. If you're buying a call option, you are placing a bet that the stock price will go up. That's why you're buying. So your profit and loss opportunity will be greater with every increase in the price. And if price fall, your downside is protected. This side is protected to the limit of your premium amount. So strike price is 1800. Let's kind of look at this broken line. Anything on the right, that green shaded area, is your in the money movement, and anything on the left is out of the money opportunity. So similar to, so to understand this whole thing, if you can memorize this two chart, it will make sense. So if you're put, you're placing a bet that stock price will go down. Therefore, with every decrease in the price, you have more opportunity to make more money. Call, when you're placing a bet, when you are placing a bet that the stock price will go. So every increase in price will give you more profit. But in both scenario, put or call, as a buyer, your downside, your loss is limited to the premium that you are paying. Hope this makes sense and this is clear. Now, the next piece that we wanted to touch on in this video is that who is it meant for? Because I use the word that you buy put because you're betting as if stock prices are going to go down. And when you buy call, you're placing a bet that the prices are going to go up. So is it a betting game? Is it a speculation? Is it gambling? What is it? So, my friend, first of all, I think buyers, you need to think this through from a buyer as well as seller perspective, which is a writer. So, buyer or holder of the option, they are pretty okay because they are getting into this agreement with a very limited loss, and their loss is fixed upfront because they have got only money that they will lose is the premium that they have paid while buying that option. Whereas as a writer, as a seller, you have unlimited exposure. Your unlimited exposure is that because there's no, sometimes stock could fall or go up 20, 30%. So you're getting a very modest income, but your liability in case the stock goes in the direction that buyer is hoping, then your loss can be unlimited. So that's where, as a writer, if you're selling these options, then you need to be thinking about hard. But as a buyer, I think you are in a good position because you have the opportunity to make money, but your downside is protected, it's fixed. And then touching on whether it's meant for investors who are looking at long term, who are running it as a business, who want to make money, or speculation where you kind of flip the coin and sometime you win, sometime you lose. No, I would say the answer is that yes, stock options are meant for both and used by both. There are speculators also in this. There are particular strategies that speculators kind of follow. And there are investors also who could kind of minimize and eliminate the risk when buying stock option. And chances are that more time than not, they'll make money from the options. So first, let's think from an investor perspective, you and I, who are looking to kind of invest money and make money. So what are the good strategies? So I think you should always go into option on a covered basis. So covered options are highly recommended. How does the covered option work? For example, if you're selling a call option, if you are a writer of a call option, you're selling that, make sure that you have those shares in your demat account before you kind of sell a call option. Because if the price goes higher, you should have the opportunity to deliver on those shares. Otherwise, your loss can be quite huge. So cover yourself in terms of having those many shares for which you are selling the call. Same way, if you look at it, if you're writing a put option, if you're selling a put option, then you need to make sure that if prices really go down, you must have enough cash to able to take the delivery of those shares that you have contracted for. So it's very, very important for you to kind of get into covered option. If you go into naked options, the other extreme, where you are not covering yourself, is called naked option. There, your loss can be huge. For example, you sell a call option for Tata Motors at say 175 price. When you sold, the price was 150. You didn't expect it to go any higher than 175. It so happened by the time the expiry date comes, it becomes 200 rupees. So on each share, you'll be losing 25 rupees on that. So that's, and you need to kind of do those calculation that you're kind of taking that much risk for a very modest premium amount. So my advice, my suggestion as an investor, as a businessman is to always get into covered option and not naked option, because naked options, once or twice you can be lucky and make money, but the time when you're not lucky, you will lose quite significantly. So very, very important to stay away from that. Speculators, on the other hand, act as gamblers. They're betting on number of outcome, which could be very, very riskier. They usually don't kind of go in a covered option because they are betting man, they are gambler. They are kind of spending little amount and hoping that that will double or that will give them good income. So they usually deal with the naked options. But there are migration mitigation strategies available for dealing in naked options. We can touch in more detail later on. If you're interested in this topic, let us know through the comments. But there are strategies like straddle option strategy, strangles option strategy, where you, if you're selling one particular option, say call or put, then you're buying also the other option so that you're minimizing the risk. So there are ways you can manage, and that's usually the areas where speculators operate. It can mitigate some risk, it doesn't eliminate the risk. Whereas if you're dealing with the covered option, you are basically eliminating the risk of losing money. Yeah, you may have the opportunity losses on a covered basis, but you will never have real loss. Is therefore, as an investor, I would always say do it on a covered basis. As a speculator, you can get into naked option, look for those mitigation strategy. Um, but retail investor, an individual investor who's new to the stock option area should strictly stay away from naked options, uncovered options, because your losses can be really, really huge. We hope that you like this video. I hope you found this simple. Please do provide us your comment. It's very, very important for us to know how you're finding our content. And if you're not subscribed our channel as yet, please subscribe A to Z Learning channel so that you can get the notification of our new videos at the earliest possible. Good luck with the investment. Enjoy.